car maker. It is not a car company at all, in the same way Google is not a search engine. Tesla doesn't appear in my long-term investments, my 12-month holdings, for a very simple reason, that it's too volatile for me. Okay, I don't like the high volatility for a 12-month holding. However, on the trading side, here we use my indicator and algorithm pipspredator, which looks for trends. Now, as you will know, we don't find trends when they're right at the bottom because we don't have a crystal ball. They usually show some degree of momentum, and then when there's a variety of patterns which the algorithm recognizes, which tend to suggest that a trend will continue, we'll get a high probability indication, and you can see it over here, and that's what it is. This is basically what is the essence of trading. There's a couple of extra points you need to know. So with Tesla, yes, it shows on the 1 hour bars, so each one of these bars is 1 hour. Yes, it shows a long position at the moment. Now, in actual fact, that's off the back of an earlier long position, so it's been there for a while in any event. I just want to give you an insight into what it is that trading involves. Now, there's a couple of important things. One is not just the getting in part, whether it's that green arrow indicated by, like I said, recognition of patterns, which have happened. We sort of have a library of patterns, which doesn't just go back the last 2 or 3 patterns, but we know there's a higher probability when certain patterns or patterns which are similar to existing ones repeat, that there's a higher probability of a move upwards, and that cause of that move may or may not occur. If it doesn't occur, then the move doesn't happen. The cause could be, I don't know, Elon Musk doing an appropriate tweet, but it just suggests that things are getting ready. And in this case, it's continued onwards since then, which was 18th of November, and here we've got right up to the 24th. So it's been a long time going up. Okay, in relative trading terms, like I said, each one of these bars is 1 hour. Okay, so that's fine. What's next? What are the other elements? Because getting in is the easy part, getting out's the difficult one. What we use on our algorithms is a volatility-based stop loss. That's that yellow line over there. Now, that's something which conventionally hedge funds use. What it is the more volatile the markets, the further away the stop loss, but further away the stop loss, smaller the position size. So you'd never risk losing more money just because the market is more volatile. And because it's more volatile, your stop loss is further away, so you don't get stopped out by noise. And if the market's less volatile, then your stop loss is closer, but your position size is larger. So again, your risk is the same. But what stays consistent in that is the fact that you're able to make the trade bespoke to the volatility of the market. So that's the volatility-based stop loss. The red dotted line is not a profit target. We don't use profit targets for a very simple reason. We'd want profits to keep running forever. Why cap your profits? You always cap your losers. We never add to losers. Losers add to losers. Winners add to winners. So when we see a winning position, like over here, and by the way, if you've got any questions, put it in the chat and I'll reply back to that as soon as I can. But when we see the price go up to that first red dotted line, you do another trade. Same as the first one, which is called skyscrapering, or you might do a half position as the first one, which is pyramiding. Why do you do that? Well, winners add to winners. There will be about 20% of your trades will go on to trend. And if only you knew which 20%. Let's be absolutely clear, and you can look at any hedge fund data on this. We don't just pick 100% winning trades. I wish we could. Nobody in the history of the world's ever done that. If you look at George Soros's book, The Alchemy of Finance, he has a diary in the second half of that. You'll see he's right about 50% of the time. And if you look at some of my books over my shoulder, Mind of a Trader, for instance, where I interviewed Bill Lipschutz, global head of foreign exchange trading at Salomon Brothers, guess what? He was only right about 50% of the time. The point is, the 50% you're right, you're making more money than the 50% when you're wrong, okay? So in his case, what had happened? When he was right, he was adding to those winners, see that red dotted line, and putting a stop loss where the green line is. Now, that's a lot of information I put there. If you want to learn more about this, just go to my website, alpeshpatel.com. But I just want to give you a flavor of what it is traders are trying to do. By having some simple rules which are generic across the hedge fund industry, you're avoiding the biggest mistakes, which 70% of private investors make. 70% of private investors lose money. 70% of private investors all make the same mistakes. We know this because we've researched this with retail brokers. I've even published the mistakes that they make because the retail brokers gave us anonymized data to tell us. And what retail clients do and the mistakes they make, they add to their losing positions. They cap their profits. They panic at the first sign of profits. They take them too soon. They put their stop losses too soon. And you'll understand from everything I'm saying, we've avoided all of those problems. We've avoided all of those problems that private investors make. So by making sure that the stop loss is volatility based and never adding to a losing position, we use two tenets of the hedge fund industry to make sure we didn't have those losses, which so many people make. Anyway, this is Tesla. What's going to happen next? People say, oh, what's going to happen with Tesla? Is it worth a buy? Well, like I said, don't invest for it because it is too volatile. However, would I trade it? Yeah, of course. Why not? Look, got these ridiculous trends. Wherever you've got a trend, you've got some momentum. Why not? And don't forget, this is the same data which is available to anybody. Many brokers will give you this live real-time data for free. All we do is use our own little algorithms there, which tell us when there's a high probability pattern that the price is likely to move up. And then the other rules, like I said, the rules about stop losses and adding to winners. That's the essence of what trading is. And despite the fact 70% of retail clients lose, the reason they lose is because they don't do those very simple things that I've mentioned in this. If you like what I'm saying, you can download a free copy of my book and a free trading course on alpeshpatel.com, or learn more about how algorithms are used in the markets by going to pipspredator.com. I've spent my life trading, I think, since I was a child pretty much and a teenager. So I hope you found it useful. I'll do some more of these live broadcasts on stocks which are keeping people's interest in the future. Thank you very much.